All right, everyone. So let's go ahead and get, you know, started here. So first and foremost, the reason we're doing this presentation and the reason we wanted to really share our knowledge here is because 20% of the participants in our cohorts are either accelerators or venture studios. And so that's a lot. So if you sort of join late, we've launched over 400 venture capital firms to date. So, 20% are accelerators or venture studios. So it's quite a lot. So we have a lot of experience here. And we get a lot of questions about this. We actually have like tracks for accelerators and venture studios, and we often see people ending up in one or the other just because they sort of didn't know what was what. And really, accelerators and venture studios are very, very different. Okay. So let's just start with like some of the basics, right? So the accelerator model, you're basically like doing sort of more light touch programmatic help, right? You're sort of recruiting companies and you're recruiting founders with their own ideas, okay? So you're not coming up with the ideas or anything like that. You're basically just providing a guidance and a system to help founders with ideas accelerate to get to these milestones much faster, right? So you're always like sort of recruiting founders into your programs. You're helping them accelerate their growth. These are typically done in a very like cohort-based type of setup, where every quarter or twice a year you launch a cohort, you recruit for that cohort. You typically are adding a lot of mentors, right? That are coming in and mentoring and helping those startups. And they're very networking based, right? They're like designed to sort of help founders like turbocharge their network. In many cases at the end, there's also a capital component where you sort of fund all of the companies or the best companies. Okay. So that's sort of how an accelerator works. Okay. A venture studio is very different, right? So a venture studio is like a factory, all right? And the folks that are starting venture studios, they're the ones that come up with the ideas. Okay, I want to be clear about this. So like in an accelerator, founders come to you with their ideas and you sort of give them infrastructure and help them. In a venture studio model, you come up with the business ideas and you have like a factory, right? That sort of makes companies. Okay. It's like a company factory, essentially, is how you sort of want to think about this, right? So you're literally like building the startup like from scratch within this sort of organization, almost like it's on like an assembly line. Okay. There's, a lot of milestones that you sort of have to reach. Kind of think of that as the assembly line. So step one, maybe get the validation. Step two is this. Step three is this other thing. So this is what generally also these studios have in common. They sort of act like a co-founder, okay? And you end up taking like a lot more equity, and we'll talk about that as a result of that. And they generally have like services built in. So for example, you have like a marketing service that's kind of built into the studio. You have, maybe like a prototyping service that's built into the studio, okay? And you're coming up and you're using all of these things to sort of like make these ideas and bring them to market, okay? So that's sort of how a studio works. And at the end of it, there's also capital and there's a fund, and we're going to go really deep into this moving forward. So let's talk about like some of the challenges with each of these sort of models, so that you're also kind of clear kind of some of the downsides and also sort of how to kind of maybe work through it. So in an accelerator, you like have no control, right? Like you're coming in, the founders are coming in, it's their ideas, and maybe that's okay, right? The founders are sort of like codependent on this infrastructure that you've built out to sort of get to a next milestones, and that could be a good thing or a bad thing. You generally don't get a lot of equity in an accelerator, and recruiting's a lot of work. You have to like set up like events and all this other stuff so you can fill a cohort. Okay, so a lot of your operations as you built out the accelerator are like around recruiting founders to come into this program. And it's very competitive because there's lots of accelerators. There's a lot of famous accelerators, things like that. So it's like, it's really challenging from that perspective. On the venture studio side is the exact opposite. You essentially have almost too much control because you're like kind of like a co-founder into these companies. And you're going to be, it's not like an accelerator where someone comes in, boom, you help them, and then they're kind of on their own. You're going to be involved with this company through and through, all the way through exit. So there's just a lot more involvement there. Okay. This other point we have here, too much equity, and the reason we want to say it this way is venture studios have a lot of like follow-on financing risk. Okay, so because venture studios typically take a very large amount of equity, 20-30% of a business, the cap table of those businesses that come out of those venture studios are just naturally going to be very different than any other startup that a VC, a follow-on VC at the Series A or at their Series B sees, right? And so that creates a lot more diligence friction, and a lot of VCs simply just don't back venture studio companies just because the ownership is so different. That doesn't mean they don't, right? Like, for example, Atomic has a great partnership with like Andreessen Horowitz, and they're able to get their companies funded no problem because of their relationship. So this is not like a hard set rule, but it's just something to kind of think about, right? Like like your companies are going to have very, very different kind of cap tables than every other startup that a normal like VC would see. And that creates, downstream financing risk. Okay. And then finally, you're basically, accelerators are in the business of like recruiting companies and founders into their programs. You're in the business of like recruiting CEOs, right? Because you have all of these ideas that and now you got to build out the team to be able to do that. So you got to find like a CEO to take this thing, right? And then that's pretty tough, right? Because you're sort of trying to recruit a CEO at like a pre-seed or early stage. And a lot of those folks generally start their own companies, right? And so it's like some of them kind of think about. And then, usually the CEOs that come in at the later stage, they're not used to kind of operating at the pre-seed stage. You know what I mean? Like the sort of hired CEOs, right? So it's like a constant like challenge that these venture studios have. These are not things that can't be overcome by any means. I just want to make sure that sort of it's people know, because they can kind of build out the right thing for them. Okay. That being said, the accelerators and venture studios, despite all of these like operational differences, which we just talked about, they have sort of like the same legal structure. Okay. And I don't need you to go into the details of what I'm showing here. We actually wrote an article about this, and we'll post this in the chat about how all of these entities sort of interact with each other. But let me sort of zoom in on some key concepts here. So in both like an accelerator and a venture studio, you're going to have what's called a management company. So the management company is what controls everything. It controls the brand, controls a lot of the operations, hires people, it does all this other stuff, right? So like that is something that is controlled through a manco. Okay. So here's an example of this. And what I'm showing here is sort of like, think of this like the operating company. All right. This is what makes the businesses. So remember when I said that the venture studio is like a factory? Okay. So this is basically the factory. Okay. And you can even think about the accelerator like a factory, right? So this is what makes the companies. Okay. So if you're an accelerator, all of your recruiting into your programs, all of your program operations, mentors, if you're doing this physically, space, all that stuff, is sort of done, managed by this, and this, makes startups, right? So I'm showing here like a single startup here, of sort of how this works. But basically this entire management company is what does that. If you're a venture studio, remember how I talked about like kind of building out a team and services and like building out the assembly line? That's also handled in basically this entity. And that, comes up with like services and all this other stuff to sort of help build out these companies. So that's how they create a company. Okay. Okay. Once these accelerators and venture studios hit a certain scale, almost all the top ones also have a VC fund, okay, that's attached to this thing. Okay. So you built out this factory, the factory is really successful and making companies, and then eventually you build out a fund, right, to sort of back the companies or some of the companies or something like this, and we can cover that, right? So what ends up happening here, right, is that you end up creating a fund, right, to start backing these companies. And what's going to probably happen is, for most people here, and this is why we sort of set it up this way, is you're going to actually have multiple funds. But as a general rule, there's an LP entity. This is where your investors in your fund go in. Okay. That's called the LP entity, and that's where you wire money into the companies from. And right above that generally sits what's called a GP entity. And that's where the carried interest from the fund, it sits and gets distributed out back up to the Manco. If you have specialized venture partners and things like that, that also happens there as well. And I'm happy to take more questions on this if you wanted to kind of understand this a little bit better. And you can post us into the Q&A and we can talk about that. Okay. But generally, and we'll put, again, the entire like VC firm sort of structure into the chat for everybody to go in more details. But sort of this is how it works, right? So you basically have this Manco, and then it's the operating entity, and then you end up like building a fund. All right. So there's generally two setups. Okay. So one, and this is how a lot of people sort of start, is where basically like the venture fund acts kind of like the bank. So it like does everything. You're like, hiring people in there, you're running operations through there and things like that, right? So that's sort of like how most people start. Okay. And then the other one is the venture fund basically is independent, right? So you all the venture fund is essentially doing is investing. Okay. And that's it, right? And that's all it's doing. It's basically investing in like the top companies, and that's it. All right. And so let's go ahead and talk about these really quick, and sort of some decisions that you're going to have to make, right? So first, do you want to do you want to start with sort of like the bank or like the independent? So here's some things to sort of think about here. Okay. If the fund acts as a bank, it's really hard to sort of scale that. You're running a lot of things through the fund, which means it's going to be very expensive, and your fees on that fund are going to be very small, right? So it's going to be pretty hard to sort of make that work, but it generally works for like maybe like the first fund when you're sort of starting. Or do you sort of run it like independent? So an independent, remember, you're sort of like, as an independent, you're just naturally going to need a bigger team, right? Because you're going to need a team for the VC fund. You're going to need a team for like the operations, right? And you're likely going to have to, in all cases, you're going to have conflicts, and we can talk about that more if you have questions about it. But the conflicts at the independent level are greater, right? So it's like, do you fund all the companies that come out of your accelerator, or do you fund just the best ones? Okay, so if you fund just the best ones, how do you decide that, right? What if like you want to fund another company that you didn't decide to fund when the accelerator graduated, but you want to fund it in the Series B? How do you deal with that, right? Like these are like conflicts that you sort of have to manage, and so it's going to be more work, but it's significantly more scalable, right? So like just as all venture studios and like YC and all the top like accelerators, they're all independent, right? It's not like, usually, because it's just too difficult to sort of run everything through like the fund, right? But usually when people start, oftentimes they're sort of constrained by capital. They might just do it through the fund. Okay. Then, you know, you got to sort of like build out your team, right? And so like, how do you sort of think about like operations? Do you have like an admissions director? I'm just making this up, right? But like, do you have an admissions person that sort of works through all the applications? How do you deal with that, right? And so again, the bank option, smaller team, larger team if it's like an independent operation, you know, but you want to sort of think through that, it's like, okay, if, what does the investment team look like? When do they get involved in the program? Right? Is it like right away? Is it only on demo day? That kind of stuff. Just some things to sort of think about. Then, and this, I want to spend a little time on this. You want to sort of set up operations. And this is where we see a lot of people sort of struggle through all these 13 cohorts that we've done in the VC Lab program. So generally the best practice here is to set up the operation company first and then the VC firm second. So operation company, the factory first, and VC firm second. When you sort of try to do both things at once, it creates a lot of challenges. So first, when you sort of do the operations company first, you can think through sort of what these operations are. You sort of run it like a business, you know what I mean? It is a business. And you can get some traction, right? Like you can accelerate a few companies. You can build a company or two that you can show, that you can sort of fundraise a fund off of that traction, right? A lot of times though, when people sort of try to do both at once, it's very conceptual, right? It's like, well, I can build an accelerator because of my previous experience as an accelerator leader and this other thing. And then I think I can also raise a fund, right? And so you got to convince people of two different investors of two different things, right? It's like, I can also operate this accelerator really well. I can also operate this fund really, really well, right? Whereas most people that are raising a fund is like, oh, I can just, perform really well as a fund manager, right? So you've got like two sets of risks there in your kind of fundraising process, And so generally a better thing to do is to start somewhere, and especially with like a studio, right? It doesn't require that much. You just like come up with like an MVP of an idea and you get it funded, right? Like, or you start a company, like for all the entrepreneurs out there, it's not that different than when you started your startup or something, right? It's very, it shouldn't take that long for you to get going and sort of prove this out. If you're an accelerator leader, maybe you start with like a small batch of people, right? And you help them and you build out a curriculum off of that, or whatever your sort of methodology or approach is, right? Like you can sort of deal with this in various different ways and get going in a pretty lean way and show that you have traction and the ability to sort of come up with companies at scale. Okay. And so, and then, if you need help with that, we can help you. Okay. We can help you with setting up the operation company and thinking through that process and getting traction and things like that. Then, then you set up the fund. Okay. So now you've got some traction. Now you can go out and say, hey, I'm going to raise a fund to back, and this is where you have to make a decision, all the companies coming from the accelerator or the top 5% of the companies coming from the accelerator. Then you basically secure commitments on that fund and you perform a first close. And generally with the first close, you will, fund either like a small cohort, or you will fund one or two companies if you're a venture studio, and now you're sort of off to the races and you've sort of, built this out, right? And then you launch, right? You launch the studio or the accelerator publicly. Again, you can't talk about the fund publicly because that's a general solicitation issue, which is sort of how I started this conversation to begin with. But you can talk about this, the accelerator, right? And what it's doing, and you're recruiting and doing lots of events and things like that, which then brings mentors into your program, which could be potential LPs eventually into the fund and all this other stuff, right? So you can sort of get going and launch the studio and the accelerator. All right, so this is where we're at. Wanted to go ahead and stop it here and leave it for questions for everybody else. I see that there's a bunch of questions coming into the Q&A. So everybody, if you have questions about any of these topics, just go ahead and go put them into the Q&A here, and I will go ahead and start answering them. Also, if you need sort of help from us on sort of setting up the operations and things like that, so I'll go ahead and have our team put a message in the chat here about kind of how to work with us and things like that, and we can do that in the chat here. So we'll go ahead and do that. I see that there's a question here from Abi. I'm sorry if I mispronounced your name. What operational aspects differentiate an incubator from a venture studio? So usually an incubator most often refers to more like an accelerator, just as FYI from a nomenclature, but basically they're, that's how, so I would just think in terms of, are you making the companies and you're coming up with the ideas, or are the, are the founders coming up with the ideas themselves? What are corporates doing regarding creating or partnering with venture studios to contribute to their innovation? A really good question there. So corporates typically try to create venture studios eventually, or things that look like venture studios internally, because it's really hard when you hit a certain scale to sort of innovate at this level. I would say most have had mixed success, to be blunt, right? Because a lot of times corporates sort of have to recruit from within from a lot of these initiatives, and it's just a lot of the folks there are maybe not as used to sort of like the startup methodology and ecosystem. So what corporates are starting to do more of is that they're sort of starting to partner with accelerators more so than with venture studios, because the accelerators have just such a plethora of entrepreneurs with like ideas and things like this. I mean, Techstars built a pretty large accelerator off of this sort of concept, because they just kept getting companies and ideas and opportunities to possibly buy them, opportunities to partner with them, opportunities to sort of help them affect a roadmap and things like that. So accelerators tend to have generally a little bit more success, and especially the specialized ones, right? Like, so if you're like an accelerator that's focused, I don't know, on insurance or something, your ability to sort of partner with corporates and have corporates become investors in your fund is much better, because again, it's very specialized. So I became a finalist for the Venture Institute cohort 14. What are the chances I'll be accepted into the last one? It's hard for me to say, Zwara. That's a tough question for me to answer because we have thousands of applicants that come in for the Venture Institute program. And for everybody here that doesn't know, Venture Institute is a program where we help people that are trying to break into venture in various different roles, like an analyst, associate, things like that, and sort of learn about the whole entire venture capital asset class. What are the deal structures for founders that are an accelerator versus studio? Great question, Alec. What's more attractive to VCs and for founders in the market today? Okay, so accelerators typically invest a small amount, 100K. They typically do it very programmatically, like when you get to like a demo day, and it doesn't have to be 100, it could be 50 or whatever. And they usually get something like 5% of the company or something along those lines as part of the deal. It's sort of like a lot of them have sort of like this standard deal. All right. Venture studios, again, venture studios are the founders. The venture studio is a founder, or is like a co-founder. And what a venture studio does, Alec, is that they recruit CEOs right? For a lot of these ideas that they're sort of trying to come up with and build and scale out. So in that, and when it acts like a co-founder, it's not uncommon for venture studios to get 20 or 30% of like the company, but it's a very different model, right? Because you're sort of they're coming up with the ideas, they're bringing in other resources and stuff like that, and they're sort of recruiting a CEO, and generally that CEO has a lot less ownership than a traditional co-founder naturally, right? So it's different. Um, I sort of covered this on what's more attractive for VCs. Again, a lot of VCs are just not used to investing in venture studio businesses that have these cap tables that are a little different. So that generally creates more downstream financing risk. And how the best venture studios have overcome this is that they've just went out and built out partnerships with great VCs that sort of lead the next round of financing, essentially. And that's how they were able to sort of kind of get around this issue, but this issue is very real. Okay. Um, you know, whereas the accelerator model has been sort of tried and true. It's pretty common for this to happen. It's pretty common for companies to go through accelerators. So that generally doesn't create as much risk. Would a studio own the full equity when incorporating a new studio venture, or keep stock option for the CEO, like 25%, 20% of first setup? Um, yeah, I mean, I've seen this done in multiple different ways, Waleed. So this isn't like a one kind of way uh, option here. But generally, the way it sort of works is that you either incorporate the company like right away, like when you have the idea, or you sort of incorporate the company after you've hit some sort of milestone. And that's going to be part of how you build out your sort of assembly line. So if you incorporate the company before you have the idea, or just at the idea stage and haven't hit a milestone, then yeah, naturally you would sort of kind of built in like kind of what the equity is for the studio, and you would create either an option pool or a certain amount that's sort of available for a CEO to recruit and so on. If you're milestone based, then maybe the first milestone could be like if you hit this level of validation because of like the process that you have, you recruit the CEO then, and then naturally you incorporate you incorporate a company then and recruit a CEO and kind of build out a team. So there's two different ways to do it. Both I've seen be pretty successful. Regarding those corporate partnerships with accelerators, do they ever become LPs in the fund as a way to participate in upside of the whole sector? How would you structure that conversation? So yes, corporates become LPs in accelerator funds. And in my example previously, Stacy, I mean, Techstars built a pretty big business just off of like this entire model. That being said, there's a few things that you need to sort of be aware of, okay? Corporates are a very different style of limited partner than your traditional limited partner. So what are traditional limited partners like? Like, they invest in the fund because they believe in the mission and because they want to get a really big return, okay? That's basically like the reason. So your pitch kind of has to hit on those notes in order for you to be successful. Corporates rarely invest for return. I mean, it's kind of like a nice to have almost, like they have like it's good to have a return. And don't get me wrong, they're capitalists still, but they're generally investing for some other type of corporate initiative. Okay. So the process is more like an enterprise sales process. It's not like pitching a fund of funds or a professional, limited partner or even a high net worth individual. You're basically going through like an enterprise sales process where you sort of have to be multi-threaded, where you sort of talk to the project manager, the CEO, the director of corporate innovation, like in parallel. And you're sort of positioning the fund as a way to solve an issue for them, typically related to corporate innovation. And then, they generally will budget for that, and eventually they may make an investment. And as you can imagine, Stacy, this could take a very long time, right? Just like any other enterprise sales cycle, which could be like a year long. This could be like that or longer. And usually when corporates come in, that there could be a lot of changes happening, right? The person that was like your champion maybe got got let go or something like that. So it's a very complicated process. So I want to sort of put that out there. That doesn't mean you can't do it. We've had several funds be raised this way, um, but just some things to sort of watch out for as you kind of build out your fundraising strategy. The venture studios is mostly deal with successful entrepreneurs with previous exit. Is there a problem scouting founders and CEOs for a venture studio? Does it mean that someone who started a entrepreneurial journey doesn't suit? So I'm gonna like paraphrase your question, RK. Look, think about what you're doing when you're sort of starting a venture studio, right? Or like the kind of people that are coming out and starting a venture studio. You're basically saying, hey, instead of starting one company, I want to go out and build a factory of companies. Now, who can credibly make that case, right? It's generally going to be an ultra successful entrepreneur, someone that's been so successful as an entrepreneur that they can build out, they say, hey, I need to build a factory around me now so that I can like launch all these companies because I have too many ideas, right? So typically the people that start venture studios are generally people that have been very successful, and they've generally been very successful by building several companies that were very successful in a certain area, like, I don't know, marketing tech or fintech or something like this. And so what they realize is that, hey, in order for me to get this fintech business to scale in, Mexico, I'm making this up, you need to have these kind of partnerships. So I need to have the banking partner. I need to have this thing. I need to have a developers on my team that really understand like hardcore financial infrastructure. And it's like all the companies that I've built had these things, right? So they basically built out that infrastructure into the assembly line of the factory, and then they start putting out ideas, right? Like I have a payments idea, I have this credit card idea, and they start running them through processes to sort of get them to market. Historically, that's how they've been built, right? And so, that hopefully that answers your question here. If you have more questions, you can ask in the Q&A. From your experience, what are the most loaded expense lines for venture studio beyond investment capital? Thank you. Well, you have an enormous amount of operational costs, right? Just if you think about, well, initially it's not that bad, but if you want to build 5 companies at the same time, or even 3 companies at the same time, you're going to have to sort of like stretch out like your developers, right? Like development team, and build them across, companies. Then you have to, you probably need some pretty buttoned up like financial operations to make sure that the budgeting is done sort of correctly. You have a pretty big load on like project management, and pretty much all the folks we've talked to that have built venture studios, they also mentioned this, and this is not like a financial cost, but it's like, I don't know, maybe a psychological cost or whatever. Like, when you're building these companies, and they're kind of like your children, you know what I mean? And like, if one of them's like sort of not doing as well or failing, and other ones there, it's like, how do you sort of delegate resources to that? It's pretty tough, right? Like because again, like you put a lot of effort into this. So managing that is very, very complicated, and so, I would say that's where you sort of start, as a first step. For both of these models, they're more expensive to sort of set up, right? Because a traditional VC firm has, like 3 entities. A fund like this, or a venture studio, or Accelerator is 4. Then you have to really think through all the ethics issues with this. Like, again, do you fund everyone? Do you fund some of them? How do you deal with that? Right? How do you make sure that you're not self-dealing? Right? Like if the studio is sort of taking 20% of the company, and the fund comes in right after that and marks it up and sets the valuation of the company, right? That means that your equity in the studio went up, right? Because of the fund that you sort of built out, right? And so that's a pretty serious conflict of interest and a self-dealing issue. So how do you deal with that, right? So you're going to have like investment committee, LPAC, and all these other things to sort of make sure that you manage all of these conflicts, right? So that's going to be a pretty big expense across, or not a big expense, but a decent expense to sort of think through and make this done right. You know what I mean? So hopefully that's helpful. Okay. What do you think about upfront investment with the small ticket sizes from a fund company in an accelerator and charge ventures with management companies for operational costs for long-term sustainability? Um, I mean, like this has been done before, right? So arguably, I think 500 startups, I don't know if it still works this way, but it did work this way. So they would sort of charge like a tuition fee, right? So they would make the investment and charge a tuition fee. That if you have that though, couple of things that you got to think about. So first, you've got a messaging um, challenge there with founders that you have to deal with, right? And remember, your goal as an accelerator is to sort of recruit the best the best founders you can. And second thing is you have to explain this to your LPs, and that's different, and so it may make the experience of fundraising a little bit more challenging, right? So look, I want to refrain from like kind of giving you like a personal opinion on this, Kagil, but I just want you to sort of think about what some of the implications of this are, right? And I get it, right? It's again like operations of accelerators are expensive, right? Naturally, you have to hire people, right? And so I get it, right? What you're trying to accomplish here. Um, what is a typical venture studio team structure, and what does a normal day look like? I wish, I wish there was like a thing I can tell you, Ahmed, about like how this works, but there's a lot of variation because remember when I was sort of answering this question before, it's like a factory, and it's generally a factory that's built for a very specific style of company. Like if you want to build out like, I don't know, medical device companies in a particular area, your team is going to be, you're probably going to have some regulatory people on your team that's going to help you make sure that you clear FDA or whatever your local regulations are, right? You're probably going to have probably some really good enterprise salespeople that can navigate the difficult sales cycle, right? And so like generally these studios when they're built, they generally have a thesis and they generally try to replicate kind of startup creation in a similar market. It's very rare that you're going to see a studio that's going to build out like a medical device company and then a fintech company and then an e-commerce company, right? Just because you don't no longer have economies of scale on the service providers that you have within that operation, right? And so hopefully that helps, but unfortunately there's no real way to sort of kind of answer this like this is what the classic team looks like. When you're first getting started though, I'll say that it's just going to be super lean, it's going to be like probably you de-risking a company or two companies, maybe bringing in some advisors and things like that, and that's how you get going. And eventually, you sort of figure out what the team needs to look like depending on the budget and things like that. What are the typical maths looks like? So say for example, you raise 5 million to create 20 ventures in 5 years. What type of exits need to happen to make it interesting for studio investors? Again, I think you're sort of conflating the fund and the studio for a little bit. So let's kind of set those aside. So the fund needs to perform as well or outperform any other VC fund out there. So the math on the fund, like it's the same as any other VC firm, and the operating company uh, job, whether it's a studio or an accelerator, is to help make sure that these companies have an edge and have a higher probability of success. And so that's why it makes sense for the fund to fund them. Okay. Um, Now, when people start out and they sort of just build out the operating company, it is common for some people to sort of take investment into just the operating company before they sort of launched a fund. And they use that to go and fund some companies. And because the studio, in this case, owns, I don't know, 20%, those investors will get, the proceeds pro rata from a potential exit. But again, when we're sort of just talking about the fund, it's going to have the same type of model or very similar type of model on like the upside, right? Potential. And usually it really depends on like stage, right? And so like if you're sort of investing at the pre-seed stage, it's not uncommon for a VC fund to need 30 to 40 investments, sometimes 50, to basically hit those two winners that are gonna, possibly 5, 6, 7x, 10x the fund. If you're and coming in at the seed stage, it's not uncommon for these portfolios to be roughly 25 to sort of make sure you have enough sort of risk mitigation there. And if the studio is incredibly successful and has proven that it's really successful and launching startups, it's also not uncommon for those portfolios to get smaller just because the studio has been sort of successful. So hopefully that helps here. You mentioned corporates like to partner with accelerators rather than studios. I didn't get that part about why studios are less attractive than accelerators, higher risk, fewer options. Um, in but look, there's no hard set rule here, Vanda. I just want to be very clear on this. Um, Accelerators just create a lot more companies, like, I mean, you're doing two batches a year a lot of times. And, a corporate that's a partner in or an LP might be an investor or might get to see 50, 60 companies, something 100 a year. A studio generally creates 3 a year, man, 4 a year. It's just different. You know what I mean? It's like a different thing. And I'm not saying it's impossible. It's just that the value prop of, from a corporate innovation, from a M&A perspective, all this other stuff that accelerators bring to corporates is it can be pretty compelling, especially if the thesis of the accelerator fits the corporate, right? So back to sort of the medical device example I gave earlier, if you're an accelerator for medical device companies and you're launching 50 a year, and you partner with, I don't know, Medtronic and Stryker and some of these companies, or they're even LPs in your fund. I mean, those are, they're able to sort of, like learn from your companies, partner from your companies, integrate those companies into their process, buy those companies. It just creates so many avenues on a yearly basis. And heck, just like learn, right? Learn about what the future of innovation is so that they can sort of adjust their strategy, right? Studios are they operate at a smaller scale, like much more methodical, right? And so again, there's nothing wrong with that in per se, and I still think it's possible for you to raise money from corporates. It's just the value prop is very different. How can venture studios differentiate itself from regular venture from the perspective of an LP? Why would anyone invest in a venture studio? Um, so the reason people invest in venture studios is because it is possible to get some incredible outcomes while you also de-risk these startups. So, for example, science, right, is a good example. I think they spun out like Dollar Shave Club out of it, right? And so, for all the stuff I've kind of given you as sort of warnings, that there's been some super successful businesses that have been launched out of venture studios. And so people invest in venture studio funds because the venture studio is uniquely qualified to be building these amazing startups. And in some areas, it actually makes more sense for you to have a venture studio than a VC fund. Like, for example, I'm making this up now, but like, like in some emerging markets where there's literally like no startup ecosystem at all, and you don't have the infrastructure, and like, and the entrepreneurs are sort of not used to that makes actually sense. I gave you this other example of like medical device, right, where you sort of have to have this ultra highly regulatory kind of experience there. That could make sense as well, so there's lots of ways to kind of work on this. So Jim, it is very common. We've had a lot of venture studio funds be raised in the VC Lab Accelerator, so this works. It's just that, you got to show that you have the ability with this sort of kind of factory-like approach to produce basically better outliers. That's the pitch. I'm interested in a venture studio, but I'm completely new to the industry. So how should my journey look like to that stage? I mean, I would just say like start some companies or join some companies. That's what you should do. And then if you're entrepreneurial, like maybe you'll get recruited, maybe you'll be super successful and you can start your own. Just start building stuff, man. VC Lab has both accelerators and studios. Between the two, which one produced more unicorns and what strategy made them successful? So, Grace, VC Lab has been around for 2.5 years. Okay. So we've run a lot of cohorts. We do have several unicorns in the portfolios of some of the VCs that we have. But I don't have a lot of information right now on sort of like at this level about like which type of kind of entity has created the most unicorns. And I would argue that it's really hard. It's hard to sort of for a venture studio to produce a unicorn in 2 years. It's also hard for an accelerator too. Sometimes accelerators can kind of hack this process. Like, for example, YC, right? Like a lot of companies will come into YC at a very late stage, and still believe that there's a lot of value. So there's a higher probability that a venture studio might sort of hack this process. But I don't, unfortunately, I don't have like that level of granular data. So sorry, I can't really answer your question directly. So Miguel, this is really hard to read, man. You have like a lot of stuff in here. Uh, so let me try to paraphrase what you're saying. Uh, basically the point is that in these secondary smaller ecosystems, it's harder to kind of like keep the level of startups high, and maybe does a venture studio sort of make sense there? So I've seen so I don't think you can. I don't know that you can build a venture studio because of this opportunity, Miguel or Martin. But it's true that in certain ecosystems that are not as developed, there is a pretty strong case to be made that sort of this infrastructure of building via venture studio makes sense. The counter argument to that, though, is that look at this webinar, right? I don't know where you are, right? But you were able to, now that we're sort of virtual, it kind of doesn't matter as much where the founders are, and because they can sort of get access to this kind of information everywhere, right? Like, heck, we run an accelerator it's for VCs versus startups, but we still run an accelerator, and we've launched 400 venture capital firms all over the world. 66% are outside the United States, many in emerging markets, right? Like I would say like over half the new firms being launched in Africa are VC lab funds. And I think it's about the same in Latin America at this point, right? And so like, you can also get a lot of access to information and stuff like this just because of like the virtual nature of it. So, that's sort of the counter argument. I don't know that it's one way or the other. Again, venture studios work best when you're able to get economies of scale because you have this assembly line that sort of works really well for a particular type of kind of style of company. Okay. So I would say that's actually more important than anything else. What is common approach for venture studios to have an internal fund or an external as a partner? Does a 2 and 20 model implement a venture studio? So I don't know if you caught the beginning of my presentation, but basically there's like sort of two ways to set this up, where it's basically like the fund is the bank, or you have sort of like an independent kind of VC firm attached to the venture studio. Okay. Uh, when you're first starting out, even though your operational costs are higher, like fundraising is so hard. Okay. RK, it's so hard. So you can't really deviate from like the classic 2 and 20 model, man, because you're already making a really hard case that, someone should give you money, even though you've never managed money professionally before in most cases. I mean, because you're new, right? It's a new firm, right? And so it's not you personally. This is not like an attack on you or anything. It's more just like the nature of what you're sort of dealing with regards to limited partners, right? And so, it's just hard. It's just hard to raise the fund. So you're going to do a classic 2 and 20. Initially, like the approach is two-step. You generally set up the operating company. You either build one or two companies within that and get them to a certain milestone where they're fundable. And a lot of times you'll just help them raise that capital from outside sources. And you'll say, hey, this is kind of what we can do. And then you raise a fund off of that. That's generally sort of the approach. And then you have to sort of make a decision whether at that point the fund is the bank or it's independent. Is there any case of a hybrid accelerator venture studio mixing both models? Yeah, I mean, look, there's a lot of complexity to if you recall that slide I had with like all the entities and the arrows and stuff, right? There's a lot of complexity to the structures, and there's like a lot of like entities. So in other words, a lot of companies within companies interacting with each other as you built this out. But the benefit of that complexity is that it gives you maximum flexibility, right? So it allows for you to do stuff. Okay. But just because you can do something, that doesn't mean you should. Okay. So, from a business perspective, so I'm giving you like business advice now, not like legal advice. It doesn't make any sense for you to do that. Okay. Because when you sort of try to combine them, you're like, you're kind of robbing each model from like the best benefits that they have, so if I were you, I would sort of make a choice. I got like 2 more minutes, so maybe I'll do one or two more questions here. By the way, for folks, if you need help building out like the operating company, we can help you, right? So if you're sort of not ready yet to join the accelerator to launch a fund, right, that's attached, we can help you build the operating company. Okay. And so, go to desalgroup.com/desalpartners. If you can put that in, Nils, I'd appreciate it. And you can sort of apply there and we can see if we can help you. Okay. This is for accelerators and venture studios. Okay. When do LPs look for prioritizing return when they invest in the studio ventures? So look, LPs are investing in a VC fund. So like, don't like the operating company just makes the fund like, it gives an edge to the fund or gives them a unique opportunity or access or something. But they're investing in a fund, right? And so these funds take 10 years to return. And so it's no different than any other VC fund. And, you know, the only difference I would say is that as a VC fund, there's a lot of variance between like an okay manager and a great manager. So an okay manager may be able to get like 2 to 3x on the fund in 10 years. Exceptional managers can get 50x on the fund, right? Like it's at that level of variance, right? And so like it's you got to sort of talk about why the studio or the accelerator is really great at producing these incredible outcomes. All right, everyone. Hopefully this was helpful. It's good chatting with you. We have a recording. We'll send this out to everybody. Enjoy the rest of your day. Goodbye.